3 months ago, I put together an income portfolio. Let's look at how well it's done and how you can review your own portfolio of funds. I'm Ian Shadrack, a qualified accountant with over 30 years of investing experience. I put together two portfolios, one passive, one active, with the aim of producing a yield of over 5% a year whilst also protecting the capital invested. So overall, the passive portfolio yielded 2.12% in the quarter and produced a capital gain of 0.75%, and the active portfolio produced an income yield of 1.23% and a capital growth of 1%. And this file is available on my website if you subscribe to my newsletter. You can sign up for my newsletter at ianshadrack.com, and you'll also get access to all my free files. So some of the funds did pretty well and they're worthy of further investigation. So the first one up is the Xtrackers Stocks Global Select Dividend 100. So this is the 100 highest yielding large caps, and the performance was positive in terms of capital growth in the quarter, and then also in terms of the dividend payout, we got 0.4 compared to 0.41 a year ago, so that wasn't too shabby either. In terms of the portfolio constituents, it holds some names you would have heard of, such as Legal & General and HSBC. BlackRock World Mining is in our active portfolio, and at one point during the quarter it was putting in an absolutely stellar performance. I think we did quite well by buying it when it was historically fairly cheap, and hence the yield looked quite high. It's come back a bit now, but hopefully over the medium term the performance will be reasonable. It's got a pretty chunky yield at just below 6%. Next up, not really something I'd admit to holding in public, but it's iShares UK Dividend. This had a capital growth of 4% in the quarter as the UK rebounded a bit overall in stock market terms, and the dividend payout was 0.16, which is the same as a year ago, with a current yield of around about 5.5%. This can be compared to Merchants Trust, which is the selection in our active portfolio. That generated a capital gain of 4.89% in the quarter, and it's got a current dividend yield of 5.1%. High yielding equity ETFs, the Global Select Dividend 100 did okay, as did Emerging Markets Dividend, and then also UK Dividend, with Latin America putting in a poor performance. For the quarter, in terms of exchange traded fund bonds denominated in sterling, ultra short bonds had the best capital appreciation, both government ones and corporate ones, and the yields on them weren't too bad either. It's interesting to note that for the portfolio, it's all pretty slow and steady, that nothing has shot the lights out in terms of huge capital growth, but nothing's issued a profits warning or collapsed by double digits during the quarter. So it looks like it's quite a robust, diversified range of funds that have been put together. It's important to review your portfolio regularly, and I recommend every quarter. That way you can keep track of any changes to maybe fund objectives or the fund manager, and you can also note the performance of each of your funds, and maybe also keep an eye on your watch list of funds you might like to buy if they come more into favor. It's important to have a watch list of funds that you are interested in potentially holding, so that if you do end up selling one of your funds, you've got something that you've been tracking for quite a long period of time that you know quite well, that you can then substitute in for the underperformer, and you're not making some kind of knee-jerk reaction. One of the funds on my watch list is the investment trust International Public Partnerships, which focuses on infrastructure. It's got a 12% discount to net asset value if you happen to believe the net asset value figure. During the quarter, it delivered about 1.8% capital return, and it paid a chunky 4.07 pence dividend on a 126 pence price. So the yield is looking pretty good on that one. So I won't be making any changes to either portfolio, as what tends to happen in practice is that 50% of the time when you sell an underperforming fund, in the next 12 months or so, it rebounds and you wish you hadn't done it. So generally, you're better off being a long-term holder and avoiding tinkering too much with your portfolio. As part of your portfolio review, rather than looking at rather spammy articles on pretty much a daily basis, you can put your fund into Google, click on news, and it'll come up with all the articles that have recently appeared about your fund, and you can research them in a much more structured way. With most decent funds, you can get access to the historical fact sheets and you can review what the fund manager is saying about market conditions and how the portfolio is changing over time. If you want help building a portfolio, then my portfolio coaching could be a great solution for you. Dividend investing isn't easy. It's full of what is known as yield traps, where funds with the collapsed price show an inflated dividend yield, only for you to find out that the dividend gets cut somewhere along the line, and then you've got the disappointment of reduced income and stagnant or even declining capital growth. So what some people do instead is they just sell down part of their global tracker and use that as income, safe in the knowledge that they still have a stake in a quality fund that is growing over time. If you want a fund that automatically does that for you, then you should look at JP Morgan Global Growth and Income, which pays out 1% of its net asset value each quarter to shareholders. And the performance has been pretty solid over the short and medium term. And the top 10 holdings include some of our old favorites such as Microsoft and Amazon, Nvidia and Apple. JGGI has just announced an increase in the dividend of 23% to 5.7 pence per quarter. So the current dividend yield will always look poor whilst the net asset value of the fund is increasing, and it's important not to fall into this trap and instead to look at the quality companies that the fund holds. So if you're accumulating money in your 50s looking to take an income in your 60s, you might find that things like JGGI, with their huge increases in dividends, become massive payers when you are in retirement, and that the high income funds that don't really increase their dividend much over time actually end up disappointing you when you come to draw your pension. Maybe the dividend hare overtakes the dividend tortoise.